Hello traders, what is going on? Firstly, a very happy Chinese New Year to everyone. 新年快乐. This will be a short video to prepare you on a portfolio level for the next few years. Some of the topics we will discuss in this video have roughly been covered in our last bi-weekly update video, so do take a look at it if you have not. I will post a link in the YouTube description below. While a rising interest rate environment is not going to crash the stock market into a bear territory, like in 2008 housing crisis, the way it will move in the future will be affected drastically. As mentioned in our bi-weekly update video, we will no longer be expecting a V-shaped recovery move that we see back in 2020 to 2021, as shown in the purple box. Going forward, the stock market will be moving in a manner which we saw in 2015 to 2019, the pink box. So comparing the movements side by side, it does feel a little disappointing in terms of returns. Hence, all the more reason why we need to prepare to ensure we can maximize our profit in the new environment. We also have to take note that the market is not going to shift into this new environment immediately. There will be a transition period, which we are currently in right now. So we will talk about this in detail later. So why will there be a shift in market movement? Why is the V-shaped recovery over? This is simply because the Federal Reserve's ability to flood the market with stimulus money, or the lack of it. This is correlated to rising rates, where rising interest rate means less stimulus money in the environment. We have to know that Federal Reserve rising the interest rate and providing stimulus money to the market are actually two separate actions. While they often correlate, the timing can be different. These are best explained with charts and numbers. So in this chart, the data is from November 2015 to October 2018. And I have also put a red box along the four columns that you should be paying attention to. The M2 supply, the M2 month-over-month percentage change, and the Federal Reserve interest rate. As you can see, from November 2015 to October 2018 was a rising interest rate environment. The interest rate of 0.12% in November 2015 went all the way up to 2.19% in 2018. In fact, the rate went up further to 2.4% in July 2019. It is just that there's not enough space on the screen to show the data until 2019. During this period, we can also see the M2 money supply is increasing month over month, but at a very slow rate. On most of the months, it is less than 0.5% increment from the previous month. This is not to be confused with the M2 money absolute supply decreasing. It is still increasing, but at a slower rate. The Federal Reserve is not looking to flood the market with money when they are trying to reduce inflation by rising the interest rate. Looking at the S&P price movement during this period, you will see the subdued movement. Market is still up, but not as aggressive as we see in 2020 to 2021. In fact, the 2020 V-shaped recovery was an exception. We have to also remember that there was a trade war ongoing in 2018, which caused some shock to the market as well. Now, let us explain why the 2020 recovery was an exception. Looking back at the table, we can see the Federal Reserve start to cut rate as early as August 2019. This was way before COVID-19. While looking at August 2019 to February 2020, we can see the rates are being cut, and the growth of the M2 supply was still kept in check. However, due to COVID-19, we can see the sudden surge of M2 supply in March, April, and May 2020. The average growth of M2 supply in the past was somewhere around 0.5% month on month, but we see it jump to as high as 6.45% in April 2020, which basically marks the bottom of S&P 500. And it consistently remained above 1% growth month over month for the rest of the year until 2021. This level of M2 growth is something that we have not seen before, and it is what caused the V-shaped recovery. And it was triggered by an external event which we have no control of, the COVID-19. And now that we are out of the technical recession and the latest US GDP data shows growth, we are now in an anticipation of a future environment where the M2 growth will decline. The Federal Reserve have already confirmed rate hike this year. It is only a matter of how many times. The market have also responded, and it is in a transition mode to this new environment. There may be many traders who got caught at the tail end of the stimulus-led rally, like myself, but we need to do ourselves the favor by preparing for the future. Especially after a portfolio drawdown, we cannot charge back into the market without doing proper research and taking some readiness action. Because if your strategy is a viable, good strategy, then there is a reason why a portfolio drawdown have taken place. It is because something have changed, and we cannot expect things to remain the same and then simply just rush back into the market. So all this information are nice and all, but what should we actually do? While we will not be providing detailed information on what sector and what stock to trade, as this is mainly for our Patreon subscribers, but we have to also understand that we are still in the transition mode and the market isn't really clear in the direction yet. However, we will still share some preparation that you can take on a portfolio level. Please note that there is a disclaimer here. We are mid-term traders with a time frame of 2 weeks to 8 weeks. If you are a day trader or a long-term investor looking for value, our suggestion may not be applicable for you. So let's go through some conclusion based on the macro data that we shared, the transition to this new environment, and the preparation that you can take. So let us begin with some possible conclusion that we can see from the data that we have shared just now. So the COVID-19 triggered the Federal Reserve to flood the market with M2 money supply via stimulus, and this led to a steep V-shaped recovery in the market. This movement in the market is unplanned and it was triggered by an external event beyond anyone's control. Imagine an environment where COVID-19 doesn't happen and there wasn't any stimulus M2 supply in the market. The environment will be very different from what we have now. The market will normalize in the near future. Price movement will be more subdued with a caveat that there is no any other external event as impactful as COVID-19. We can project possible market behavior with the current available variables that we have. However, we have to realize that there are always new variables added into the economy daily, which we may or may not be aware of. Next, the transition phase. So as mentioned, we are currently in a transition phase where it might last for the next 2-3 months or maybe slightly longer. Who knows? But when the transition phase is over, I think it will be quite obvious and we will definitely make some market update through YouTube video like this also. So the market will still be driven by emotion in this transition phase. There will still be some volatility with price action not really making any sense. So this kind of movement are caused by a few parties. Number one, those who still believe in a V-shaped continuation of the market and they are aggressively buying the dips. Those who are trying to transition into the new market dynamic by proper rebalancing, such as selling the weak stuff and holding cash to buy the right stuff. So this is the position that we want to be in. And then we have those who are trying to sell everything and going into the 100% defensive mode because they feel that market is going to crash. And then we also have day traders taking advantage of this recent strong volatility in the trading environment. And of course, lastly, we are still in the earnings seasons where there are a lot of big companies have yet to put out their earning reports, and their remarks on future guidance can affect the price movement. We will still see overvalued tech counters making dead cat bounce due to either short covering or simply just being oversold. We might still see overall market dropping if fears takes over again. So if your portfolio is now majority cash like myself, it is important that you do not redeploy all your cash immediately into the market during this period. You could go for 1 or 2 test trades, but wait for the transition to end to get a clear direction. So finally, going forward, after the transition period, what are the things that you should and should not do? So firstly, trading pure index are not going to be as profitable as it was in 2022, 2021. This is mainly because the stock market is no longer going to be one directional and it will be a little bit more sideways. And in fact, this can make it difficult to time a short position or get a lot of profit from a pure long position. Next, having a 100% long position on your trading portfolio is not recommended. Neither are 100% short position. So what we want is we want a balance of short positions and long position. So we want to buy outperformers in a sector that does well during a rising rate environment. And we want to short underperformers in a sector that does not do well in a rising rate environment. So technical setup entries are still okay. If you want to use technical analysis, it's fine and all, but make sure that you do so with a proper risk management and make sure that we are out of this transition phase. However, if you want to have a better edge compared to the market, it is a good time now to learn some basic fundamental. So at this moment in time, I hope this information helps you out. As we dive further into 2022, we will have more information, better direction, and then we will have more update videos like this to ensure that we are heading in the right direction. So you may also join our Patreon to learn more about what we are buying and shorting. We also have very frequent webinars, stock analysis, and discussion session, and your support will be very much appreciated. So once again, have a nice weekend and a very happy Chinese New Year.